Hi class, today we're going to be looking at chapter 6, problems 11 through 15. You should be able to see chapter 6, problem 11b. On December 31st, Sanchez Company needed to record its accrued wages for the year end. If December 31st is a Wednesday, then Sanchez Company must account for 3 days of wages. The company operates on a 5-day work week. The prior week's gross pay was $29,870, and the net pay was $19,995. They want you to journalize the adjusting entry that would be made on December 31st to accrue the wages. So what we're doing on December 31st is we're saying that we owe wages to our employees, but we have not paid them yet because December 31st is on a Wednesday and the normal payday most likely would be Friday. So you've got 3 days that you need to account for of wages that are owed to the employees but unpaid as of December 31st. On December 31st, we would create a journal entry, an adjusting entry to accrue the wages that we owed at the end of this period, which is December 31st. So we're going to debit an account called wages expense. Our expense account increases on the debit side and our wages expense is going up by the 3 days that our employees have worked, but you haven't paid them for that work time yet. So we're just recording the adjusting entry at the end of the year to accrue the wages. What you've got to figure out is the amount to accrue. And the way that we do this is we're going to take the amount that was owed, which was $29,870. We're going to divide that by 5 days in a week. In other words, we're going to get a daily amount that the employees are earning. And then we're going to multiply that by 3 days that were left in December, because we're accruing the wages for 3 days. So take the $29,870, divide it by 5, and then multiply it by 3 days, and that will give you the amount of the accrued wages. The accrued wages will go into an expense account so that those expenses can be matched with the revenue on your income statement for this period. In other words, it makes the expenses go up. That's why we've debited it here. But we've also created a liability because we're not going to pay that payroll until the next year. Whenever that Friday fell in the next year, we would actually pay this amount that was owed to the employees, plus we would pay them for an extra 2 days. But this journal entry here is just to record the accrual of wages at the end of the accounting period, which is December 31st. Our wages payable is a liability. Our liabilities are increasing by the amount that we have accrued for this time period, which was 3 days worth of work. And that's all you need to do for this particular problem. We're going to move to problem 612. This time, John Torre is the only employee of Bamberg Company. His pay rate is $19.70 per hour with an overtime rate of 1.5 times for hours that are worked over 40 in a work week. For the week ending March 31st, he worked 44 hours. Calculate his gross pay using the overtime premium approach to calculate his overtime pay. The overtime premium approach was discussed in chapter 2. So you should know how to do this. This comes from chapter 2, but this is a review, and I'm going to show you what they're asking you to do here. First of all, they want you to calculate the regular pay. To do that, we need to take the total hours worked, which was 44 in this case. He worked a total of 44 hours. We're going to multiply that by his hourly pay rate. When we multiply that, that will give us his regular pay. So his regular pay is $866.80. In part B, they want you to calculate the overtime premium pay. Notice this is using the premium approach that comes from chapter 2, and this is how we calculate the overtime premium pay. We put it into a formula where we take 50% of the overtime hours and multiply it by the pay rate, and that will give us the overtime premium pay. So in other words, we took 50% of the overtime hours. There were 4 hours of overtime that they worked above 40. So 50% of 4 hours, and then we would multiply that by the regular pay rate, which is $19.70. That will give you the overtime premium pay. In part C, they want you to calculate the gross pay, which would be your regular pay plus your overtime premium pay. So your gross pay amount is $906.20. In part D, they say since the company holds back 1 week of pay, Toro will not be paid until April the 7th. What adjusting entry would the company make in order to record Torre's salary in the first quarter of this year? The adjusting entry would be made at the end of March. So this journal entry would be made on March 31st. We would accrue the salary. We would debit the salary expense to increase it for $906.20, the gross pay, and we would credit the salary payable, which is a liability account. Our liability accounts are increasing by $906.20. This is an adjusting entry that's showing that on March 31st, you owe this amount to the employees. Now, you're not going to actually pay them until April the 7th, and they did not ask you for the journal entry to do that. So all they want is the accrual or the adjusting entry that would be made at March 31st, the end of the first quarter. So I'm going to move to the next problem, which is 613. In Oregon, employers who are covered by the state workers' compensation law withhold employees' contributions from the wages of covered employees for the Workers' Benefit Fund at a rate of 1.1 cent for each hour or part of an hour that the worker is employed. Every covered employer is also assessed 1.1 cent per hour for each worker employed for each hour or part of an hour. The employer-employee contributions for workers' compensation are collected monthly, quarterly, or annually by the employer's insurance carrier, according to a schedule that's agreed upon by the employer and the carrier. The insurance carrier remits the contribution to the state workers' compensation department. We're going to be the Umber Company, a covered employer in Oregon, and we turn over the employer/employees workers' compensation to its insurance carrier by the 15th of each month for the preceding month. During the month of July, the number of full-time employee hours worked by the company's employees was 26,110. The number of part-time employee and hours was $3,490. What they want you to do is they want you to compute the amount the company should have withheld from its full and part-time employees during the month of July for workers' compensation insurance. The amount that they want to record would depend on the full-time employee hours, which was given at 26,110. We're going to add the part-time employee hours of 3,490 to that to get total hours. And then we're going to multiply these total hours by the workers' compensation rate, which is 0.01, and that actually should be 0.011. It's showing up as only 2 decimal places here, so I'm going to increase that so you can see that. That's the way it should be showing, as 1.1 cent. We will multiply this 0.011 by 29,600 hours, and that will give us the total workers' compensation insurance that is owed for the employees. And the employer is also going to have to match this amount, because the employee and the employer are going to pay the workers' compensation. Now for B, they wanted the title you would give to the general ledger account to which the amount withheld from employees' earnings should be credited. The name of this ledger account is workers' compensation insurance payable. It's a liability account. Anytime you see the word payable, it means that you owe the workers' insurance. And so it would be credited to the liability account. In Part C, they actually want you to journalize the entry on July 31st to record the employer's liability. Only the employer's liability is what they're asking you for in C, for the workers' compensation insurance for the month. So what we have to do on July 31st is we have to create an adjusting entry to accrue the workers' compensation insurance. We will debit the workers' compensation insurance expense account to make it go up for $325.60, the employer's liability. This is only the employer's liability for this journal entry in C. We would credit the workers' compensation insurance payable because it's a liability. So this is the adjusting entry that you would record to accrue the employer's liability for workers' compensation insurance for the month. Then we're going to move to D. It says journalize the entry on August 15th this time to record the payment to the insurance carrier of the amount withheld from the employee's earnings for worker compensation insurance and the amount of the employer's liability. So this is the journal entry that we would make on August 15th. This is when we're going to turn over the workers' compensation insurance to an insurance carrier. So what we're going to do is we're going to create and debit an account called workers' compensation insurance collected. This is an amount that you've collected from the employee's wages. So the employees owe this amount, and the employer also owes the same amount. Remember, we credited the employer's working compensation insurance payable on July 31st. So what we're going to have to do is reduce the amount that we owe for workers' compensation insurance payable from the employer's entry. They owe $325. and the employee owed also $325. So the total amount that they're turning over to the carrier, the insurance carrier, is a credit to the cash account for $651.20. That's the total of the debits, is what you're decreasing your cash account for. You're responsible for collecting from the employees' paychecks this $325.60, plus you owed $325.60 as an employer. And so we're going to turn over the total of these to the insurance carrier, and that will make the cash be credited. And this is the journal entry that would be recorded on August the 15th. So I'm going to move to the next problem. And on this problem, it says at the end of June, Morton Company had a balance of $49,900 in the vacation benefits payable account. When employees have earned vacation, we put it in a liability account until it becomes paid vacation when the employee decides that they're going to take some vacation days. During July, employees earned an additional $3,110 in vacation benefits, but some of the employees used vacation days that amounted to $24.90 of vacation benefits. The $24.90 was charged to the wages expense when it was paid in July. So it goes to the wages expense when it's paid in July. What is the adjusting entry to accrue, what is the adjusting entry? What adjusting entry would Morton Company make at the end of July to bring the vacation benefits payable account up to date? This is an accrual of vacation that has been earned by the employees for the month. And so the accrual is a debit to vacation benefits expense. The expense account is increasing. That's why we're debiting it. And we're crediting the vacation benefits payable account for the accrued amount. Now in Cengage, they wanted you to use $620. And this is how they come up with that $620. I've made some notations about this particular problem and how they did it in Cengage. But the vacation that was earned during the period was $31.10. That was given. They told you that some of the employees use vacation days of $24.90. We'll subtract the $24.90 from the vacation days that are earned. And so what we have left over is $620. And that's what they've used to record the accrual of vacation benefits. And they've given you a hint here also, which is telling you that the vacation benefits payable account, the beginning balance that would be in the ledger is the balance at July 1st of $49,900. That was given in the instructions to the problem. Then you would add the vacation pay that was earned during July, and then you would subtract out what was paid out in July, less the vacation that was used during July, and that will leave you with the vacation benefits ending balance in July of $50,520. But in Cengage, they just wanted you to record this journal entry. As an instructor, I saw another way that you could have recorded this. Now, you could have recorded two journal entries instead of the one that they did up here. One would be to accrue the entire vacation that was earned during the period, which we would debit to the vacation benefits expense, and we would credit to vacation benefits payable. This is to accrue the entire vacation amount that they gave to you. They also paid out some of their vacation benefits during that period of time. So that would have reduced the vacation benefit payable account and would have also reduced our cash account once it was paid. This method was not used in Cengage, so they didn't want you to do this method, but I just wanted you to know that there's a different way that you could have handled this particular problem. But this is what they want you to record in Cengage. So you need to record the amount of 620 in the answer for this problem B. And so that's how they've done this particular problem. And really there were two ways that you could have approached it, but this is the way that Cengage wanted you to use, and this is the one that you're going to get credit for. So I would say to use this method that Cengage used, even though there are other ways that we could have looked at that. So I'm going to move to the last problem that we're going to discuss in this video, and it's going to be 16B. The form below shows the amounts that appear in the earnings to date column of the employee's earnings records for 10 full-time and part-time workers in the Ranger Company. These amounts represent the cumulative earnings for each worker as of November the 1st, the company's last payday. The form also gives the gross amount of earnings to be paid each worker on the next payday, which will be November the 8th. In the state where Ranger Company is located, the tax rates and bases are as follows. That's the ceiling. They've given you the tax rate and the ceiling for FICA OASDI. The ceiling is on the first $137,700. This is your FICA rate for OASDI. You'll remember this from previous chapters. This is the FICA HI, 1.45%, and it's based on total earnings. And then the employee has to pay SUTA in this particular state, and that is taxed at a rate of 0.5% on the first 8,000 of the earnings for the employee. So this is the tax on the employees, and the employer also has to pay taxes. Remember, they have to match the FICA OASDI and the HI taxes. So the rates are the same and the ceiling is the same for OASDI. The employer also has to pay federal unemployment tax as well as state unemployment tax. And the federal unemployment tax rate is 0.6% on the first 7,000, that's your ceiling or your base, as they're calling it here, of earnings by the employee. The SUTA is 2.8% on the first 8,000 of earnings that the employee has. In the appropriate columns of the form shown below, do the following. Compute the amount to be withheld from each employee's earnings on November the 8th for FICA, OASDI, FICA, HI, and SUTA. They've got it in a table form right here. These are the taxes that are going to be withheld from the employees for OASDI, HI, and SUTA. These are the earnings to date for each one of the employees. They've given you that information, and they've given you the gross earnings as of November the 8th. So in these three columns, they want you to calculate the taxes that would be withheld from the employee's earnings. In these columns here, they want you to show the earnings that are taxable for the employer. And so I want to make sure that you understand that these are earnings that they're calculating here. Later on, we're going to calculate the taxes. So they have 10 employees here that they've given you the earnings to date, and they've given you the gross earnings. And what you got to do is figure the taxes that would be owed by the employee. And those are the taxes that will be taken out of the employee's paycheck. And so for FICA, on this first person here, Ruth Watson, her earnings to date were $139,000. Well, we know from the information that was given, the ceiling for OASDI is $137,700. So this employee has already gone over the ceiling. So this employee owes no more OASDI taxes on their earnings. So the tax amount would be zero because they've gone over the base of $137,700. So there's zero FICA taxes that the employee would pay, but they are responsible for paying HI taxes. The HI taxes are based on the amount of earnings that will be paid on November the 8th, which is $1,890. So take $1,890, multiply it by 0.0145, and that will give you the HI portions. Now, the SUTA amount that is owed by the employee is only on the first $8,000. So they've already collected the SUTA for this employee. So during this pay period, the employee would owe no SUTA. For the employer's taxable earnings, that's what they're wanting here, for OASDI, it would be zero because we've gone over the ceiling. This employee went over $137,700 ceiling, so there's no more that's going to be calculated as earnings for the employer. For the employer, they have to use the earnings for HI, which would be this pay period's earnings of $1,890. They've gone over the FUTA ceiling for the employer, and the ceiling was $7,000. So this employee's already gone over that amount. So this is going to be zero for the first employee. And the SUTA will also be zero because they've gone over $8,000. And it's not applicable to this pay period. So when we look at the next employee, Ralph Kinder, he has earnings to date of $14,950. He's nowhere near the OASDI base. So we're going to multiply the $410 times 6.2% to get the employee's share of OASDI. We'll take the $410 and multiply it by 0.0145 to get the HI portion that he owes. And because he's gone over the first 8,000, he doesn't owe any more SUTA. The employer is going to have taxable earnings of $410 for OASDI because they didn't go over the ceiling this time. For HI, $410 is the amount of the employer's earnings. But notice they did go over the amount of earnings of $7,000 for FUTA and $8,000 for SUTA. So we put zero in for the earnings that are taxable toward FUTA and SUTA. On the next employee, we paid him earnings to date of $4,060. His earnings this week, or at November 8th, are going to be $395. All of these are subject to OASDI taxes. So $395 times 6.2% is how we would get the OASDI taxes that would be withheld. unfortunately. Okay, I'm back again. My computer crashed on me, so I'm going to continue with where we were. So hang on just a second. I'm going to share this with you. We are on, hopefully it won't crash again. Just bear with me. We are on chapter 6, problem 16B. I think I got through the rest of it successfully. And we were working on recording the taxes that would be withheld from Sanchez, Robert Sanchez. And for Suda, the rate was 0.5% on the first 8,000. He didn't earn 8,000 total, so all of his earnings of $395 are going to be multiplied by 0.5%. That's how we get $1.98. So the taxable earnings or for the employer for OESDI for Sanchez will be $395. Remember, we took $395 and multiplied it by 6.2%. The employer is going to be responsible for that too. The employer is also going to be responsible for $395 in HI taxable earnings. And for FUTA, this time the employee has not gone over the base of 7,000. So the employer owes FUTA taxes on $395. The employer also owes SUTA taxes on the $395 because the employee did not go over the base of 8,000. And so you do all of these very similar. And I don't want to take too much more time on this because they are so similar, but I would like to go on to the employee Kenny Jack or Jack Kenny, employee number 6, because he had some special things that happened to him. That's why I've got it highlighted here. First of all, he earned $137,500, which is just short of the OASDI base. So what you have to do in order to find the taxes that are owed by the employee is you're going to have to take $137,500 from the base of $137,700, and then you will multiply it by 6.2%. So $137,700, the ceiling or the base, minus the earnings to date, will leave you with an amount that is left of $200 that is taxable at 6.2%. So $137,700 minus $137,500 is $200 times 6.2%. That's how I'm getting $12.40 that will be withheld from the employee's earnings. That's this amount right here. For HI, they're taxed on the 1850. So 1850 times 0.0145 is how they get this amount. And then the employee has gone over the first 8,000. They were paid more than that earlier. So there's 0 that is owed for SUTA by the employee. For the employee's earnings is $200. Again, I'm going to get that by taking the base of $137,700 and subtracting out what they've been paid to date. So they still had $200 that was taxable toward the OASDI. For the HI, it's the whole amount of $1,850, and for FUTA and SUTA, they've gone over the basis for the employer. And so you continue and you do all of this basically the same way. Now I've got something highlighted here too, which means that's a little bit special. So I'm going to go on down and talk to you about Candy Mark, whose earnings were $68.25 plus the $325. If you add both of these together, it's going to go over your FUTA base. The FUTA base was $7,000. So what you have to do in order to find this 175 here is you take the $68.25 from the FUTA base of 7,000. So 7,000 minus 68.25 is $175 that are taxable for FUTA purposes. The rest of this is basically the same as what we've been doing. All right, so once you get through calculating all of this, they have you to add up the total employee taxes. These are the totals of this column. They also want you to add up the total taxable earnings for the employer. Remember, this is the employer share. And so we would add the total of this column to get this, the total of the HI column to get that, the total of FUTA to get $1,190, and the total of SUTA to get $1,340. We're going to multiply that by the OSDI rate, which is 6.2%, the HI rate, which is 1.45%, the FUTA rate, which is 0.6%, and the SUTA rate of 2.8%. When you multiply that, this is the amount that the employer owes of these taxes. So the very last thing that they ask you to do see if I can get it where you can see it. There you go. Is to total the payroll taxes just for the employer. Now in Cengage, they didn't put for the employer here, so I miscalculated this originally, but all they wanted in Cengage was just for the employer. So what you're going to do is add these amounts together here, and that's how you get $393.19. But technically, you owe not only the employer's share of taxes, you would owe the employee's share of taxes too. But in Cengage, they just wanted the payroll taxes for the employer here at the bottom. And that's all I'm going to share with you today. Hopefully we've got all of this in one setting, because as you know, my computer crashed, but if it didn't, there'll be two videos that will show up for problems 11 through 15. So I'm going to stop sharing this with you, and we'll see you again next time. Bye-bye.